What is accounting? Before answering that, let us see what would happen if accounting did not exist. One day you go to the bank to withdraw money, but the bank says no because they have no record that you ever had an account there. Confused and frustrated, you leave the bank and go to a bakery to buy a cake. After going there, the shopkeeper replies, "Sorry, we have no idea about your order. We are out of stock." At that moment, you are extremely angry and start wondering, why is this happening to me? Then it hits you. There is no bookkeeping in the world. Now, let's look at another scenario. You own a company that is running profitably. You want to expand the business, so you approach investors to raise funds. The investors are interested, but they ask a simple question. Where are the numbers? Show us the financial proof. You have no records, no statements, no financial data. Do you think they will invest in your company? No. Without financial accounting, no investor will trust your business, no matter how good it actually is. Accounting is the process of identifying, recording, summarizing, and communicating financial information of a business. Accounting answers three basic questions. How much did the business earn? How much does it own and owe? How is the business performing financially? Let us start with bookkeeping. Bookkeeping is responsible for collecting all financial information and ensuring that it is properly recorded and considered. It ensures that financial information is gathered systematically and in an organized manner. There are several steps in bookkeeping. Step 1. Separate business transactions from personal transactions. Identifying and separating business transactions from personal transactions is very important because only business transactions are considered for the firm's accounting. For example, buying raw materials, receiving money from customers. Purchasing plant and equipment comes under business transactions, whereas buying groceries, purchasing a personal car, money received from non-business activities comes under personal transactions. Step 2. Choose a bookkeeping system. A bookkeeping system is the structured process of recording, organizing and tracking a company's day-to-day financial transactions. There are many applications used to track financial transactions, for example Excel, Google Sheets, QuickBook, Xero. Step 3. Single or double-entry bookkeeping. Single-entry bookkeeping is a system where only one accounting entry is recorded for each financial transaction, usually in a cash account. For example, date, May 1st, 2025. Description, initial balance. Amount, $3,000, and so on. This system mainly tracks cash receipts and cash payments and does not record assets, liabilities, or equity in detail. Double-entry bookkeeping is a system that records at least two opposite accounting entries for every transaction, a debit and a credit. For example, date, January 22nd, 2026. Account furniture, debited $5,000. Account cash, credited $5,000. This means the business acquired furniture while cash decreased by the same amount. These records are called journal entries. We will learn about journal entries in detail in the next video. Step 4. Choose between cash or accrual accounting. Cash method. Revenue and expenses are recognized only when cash is received or paid out. Accrual method. Revenue and expenses are recognized when they are incurred, not when cash is received or paid. Let us understand through scenario. A shop sells goods worth $10,000 on January 1st. The customer pays the amount on January 10th. Cash method. Income is recorded on January 10th when cash is received. Accrual method. Income is recorded on January 1st when the sale is made. Step 5. Record. This is the final step, where all identified and classified transactions are recorded properly and then stored in the database or accounting records for future reference and reporting. Once bookkeeping is completed, all financial data is converted into financial statements. This is where financial accounting comes into play. There are 5 major financial statements: statement of financial position or balance sheet, statement of earnings or income statement, statement of comprehensive income, statement of cash flow, statement of shareholders' equity. We will discuss each of these statements in detail in the upcoming videos. For now, remember this. Together, these statements show how strong, safe, and reliable a business really is. There is an important principle in financial accounting called the accounting equation. Let us understand it. The accounting equation is the foundation of financial accounting. Without satisfying this equation, accurate accounting is not possible. Let us see what this equation is. Assets equals liabilities plus equity. Assets are what you own. Liabilities and equity represent what you owe and what belongs to you. For example, you own a house worth $100,000. Out of this, $50,000 is a loan from the bank, which is liability. $50,000 is your own investment, which is equity. This means the asset is financed partly by the bank and partly by you. If you sell the house for $100,000 and repay the bank loan of $50,000, you are left with $50,000, which is your equity. Managerial accounting. Managerial accounting is more detailed than financial accounting and contains strategic and sensitive information. It is prepared only for internal users. The purpose of managerial accounting includes pricing decisions, marginality, competition analysis, budgeting, and planning. If this information is shared with competitors, they could use these strategies against the company, causing competitive disadvantage. Tax accounting. Tax accounting focuses on determining the amount of tax a company has to pay. The main objectives of tax accounting are to ensure legal tax compliance, calculate accurate tax liability, avoid penalties and legal issues,